Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 9 a.m. Mountain Time on Monday morning, November 10th. We've had a deal apparently to reopen the government, which changes our outlook a bit. We had held off on cutting risk 2 weeks ago after the hawkish Fed meeting because we thought there would be a deal within a week or two that would reopen the government and release all the information about the labor market, which would get the Fed back on track for a December and probably a January cut as well, allow favorable seasonality to work its wonder and the year on a reasonably good tone for the stock market and bond market. But next year is a very different story. So our note this week was titled Cyclical Bond Bull, Secular Bear. And we still think that the run it hot reacceleration of growth scenario is the three policy shocks works its way through the economy. Those three shocks being reversal of surging immigration, trade policy, and the slowdown in the rate of government spending, coupled with the individual tax provisions from the One Big Beautiful Bill Act, and seemingly the chance of some additional stimulus. So it could create a very different environment in 26 than we've had in 2025. But before we get there, we thought there could be one more push in the bond market to probably 3.75% or so on 10s, driven by the BLS releasing their employment reports and us seeing just how weak the labor market truly is. So that's really what this note was all about. We provided a lot of evidence about the labor market, specifically ISM surveys, regional Fed surveys, the Beige Book, the Conference Board's labor differential that suggests the unemployment rate's above 4.5%. The small business component of the ADP report, and then just the whole bank credit creation environment, which is so weak. All of that justifies, we think, the Fed cutting 50 more basis points and giving us one last leg to this cyclical bond rally that we've had this year. But next year, we think the secular bear market could reassert itself. We then went on to discuss the oral arguments in front of the Supreme Court on the IEEPA trial, the use of IEEPA to implement tariffs, that was. And we talked a little bit about Gorsuch's ratchet effect and the non-delegation doctrine. But some of the suggestions from Roberts and Kavanaugh about foreign affairs, we think creates a little bit of an opening for a solution that falls somewhere between declaring the use of IEEPA unlawful and forcing the administration into rebates, and a complete endorsement of the use of IEEPA, which we don't think is probable. The bottom line, though, and we went through this in the note, is the effective tariff rate seems to have settled in around 12%. And some of the budgetary think tanks like the Penn Wharton budget model only had a 14% effective tariff rate forecast when you finish with substitution effects. Those excise or customs duties have stabilized just below $30 billion per month. The impact on imports may be starting to wash out. Whether it eventually gets passed through to the consumer could wind up having a lot to do with whether the Trump administration gets concerned about the midterms. And after last Tuesday's elections, we could see how they might get there. And there's a really good chart in the weekly for paid subscribers showing the impact or what's going on with confidence, not just for Democrats versus Republicans, but also independents. And spoiler alert, that their confidence is falling sharply. So if you were to have stimulus that sent checks to the public, the probability of pass through to final prices goes up substantially. That's the 2021 American Recovery Plan $1.9 trillion stimulus playbook all over again. I think it would be very dangerous policy were the Trump administration and Republican-controlled Congress to decide to do that. We then went on to talk about fixed income supply and how that's going to pick up next year, and talk a little bit about the whole OpenAI CFO kerfuffle. We get CoreWeave earnings tonight. sort of a poster child for using debt to build out AI infrastructure. So that's worth looking at and how the market receives that. Next year, we think, is when fixed income supply is going to start to overwhelm the seemingly insatiable demand. We do, again, think that's next year's story, less so for the fourth quarter. But a lot of warning signs are there. So we'll be watching that closely. And then the final point we made this week that we really think is crucially important: QT ended, but DT began. DT is duration tightening. The way the Fed conducts QE, there is a liquidity bank reserves channel that's the least efficacious portion of QE. Then there's the duration impact. Buying longer term bonds has a profound impact on the pricing of securities, term premium, the pricing of longer term securities, and how it impacts other riskier asset classes like equities. The way the Fed does QT, it only works through the reserve channel. However, as we wrote about the prior week, the decision to start reinvesting mortgage paydowns into treasury bills rather than notes is duration tightening. The number's not big, it's 17 billion or so per month, but it's not insignificant either. And so this whole discussion about them restarting QT in a lot of ways is irrelevant. What's important is what happens to the duration of the Fed SOMA portfolio. If you really want to dig into this, become a paid subscriber, because we're one of the few researchers out there that are really talking about this. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thanks.